Hey guys, how's it going? And thanks for coming. I'm Nick and this is Real Life Money, where we talk about real life and money because you know schools aren't. Don't forget to subscribe, so let's get started. So this is one of the most important videos of the month, guys. We're talking about 3 stocks to buy for December 2018. Holiday season is right around the corner. Markets are just all over the place. So what stocks should we look into? That's what we're talking about. Now I'm kind of just going to give a fairly quick overview of all of these stocks, just because if I go in deep analysis of all of them, it would be like a half-hour video. So I'm going to just touch on those. And also, before the last stock that I want to talk to you guys about, I want to give a money tip to everyone out there because I think it's very important and we have to reevaluate what's going on. So let's get into it. So the first 2 stocks that I'm going to be talking about are kind of be more recession proof. I know when there's in a bear market, which we're kind of in right now because we keep going down no matter what the news is, just things are horrible. But people are still going to be using these different companies, and those are the 2 stocks that I want to talk about. And the third stock is a growth stock because everyone wants to know about growth stocks out there. So that's what's going on. I'll have timestamps so you could skip around if needed. So starting off with the first stock, guys, which I'm really interested in. I've been doing some research on it, and I think it's a good one. So moving into United Health Group Incorporated, ticker symbol UNH, and this is one of the largest, if not the largest company or like healthcare insurance company out there. And I can tell you one thing: insurance price, like healthcare costs, are not going down anytime soon. So we could see, I'll just tell you right now, their 1-year return is over 25%, 2-year over 75%, and 5-year over 250%. We could see their PE right there of around 20 or just over 20. They do have a dividend of 1.33% right now, and their 1-year target estimate is over $300. Some more statistics about these guys, like we kind of saw before, the PE is over 20. Their forward PE is just over 18. You can see their 52-week change is over 28%, which is far beyond the overall market. Now, I think this is very important to note. Not only this company, but the healthcare industry as a whole has been outperforming the market year to date. I mean, one of the reasons, because it is kind of recession proof. If we are in a recession, things are going down, people still need their medications and their drugs, and they got, they got to get high on this stuff to just live or just to have a better life. No matter what happens in the economy, they still need it. So I like that, especially for the long term, which is why I'm loving this. So let's go into some of the earnings for these guys. This was mid-October. We could see the revenues up over 12%, premiums, products, services, investments, all looking nice, double digits. Income down there, over 28% increase. So it's looking very nice with the numbers. So like I mentioned, kind of recession proof. People are still going into healthcare, insurance, and everything like that. Those costs are not going down anytime soon. That's why I'm liking them. They have the growth behind them. However, they also have a dividend. And this is something that I like to invest in. They still have that growth, but there's also that dividend. They have, I mean, for right now at least, around a 1.3%. It's not massive, but if it is down, you're still collecting that. So I kind of like that balance of growth and a little bit of income to keep you happy when things are down, like currently in the market. Now in the short term, these guys are kind of volatile. Well, they are volatile. They're all over the place. They could be up one day, down the other. But overall, they have been increasing very nicely. And I think I'm going to start buying these guys before. I mean, the second stock is definitely interesting too. But these are the definitely top stocks that I'm watching. And I would rather get in a little bit now. And could it go down lower? Absolutely. So I think over the long term, I think this is a great stock to build a position in. So moving on to the second stock, kind of similar mindset why I picked this. But let's go right into it. TJX companies. So they have a couple different companies actually. Some of their main ones is Marshalls, Home Goods, and TJ Maxx. We could see their chart. They actually are down at the current moment. They are releasing earnings. Today when I'm recording it is the 19th. They're releasing it tomorrow. So it might pop, it might drop. But definitely something to look in, not only recently, like in November, but in the coming months as well. We could see their PE around, just over 20, and they do have a dividend of around 1.5%. So these are the kind of companies that are kind of flat during growth time, like they have those tech stocks and all those big players out there shooting way up, and these companies are I guess you could say, lagging behind huge growth companies. However, with people talking about recessions coming and downtime, downtimes are kind of here already, but this is something to look into. And if you look at, if a recession comes along, people are still going to these stores. They're kind of like discount stores. They could go either like Home Goods, Marshalls, TJ Maxx. I know TJ Maxx just opened up close by me, and they have good prices. People are going to still go there if a recession hits. So let's look at some other statistics. Again, we saw PE ratio, trailing PE before. Their forward PE is just over 18, and their 52-week change is 44%. Again, more than the overall market. Now, their returns over the past year have been just over 35%. 2 years have been a little less than that, actually, over 25%, just because they had that kind of lower time when other companies were growing. But 5 years have been over 50%. Now, if you do some research on your own with this company, you will see they recently had a stock split. So they were around a $100 level, and currently they are around a $50 level. So they had a 2-for-1 stock split. So if you had a stock beforehand, let's say one stock worth $100, now you would have 2 shares worth $50 each. Essentially, it's the same. It's not like you're making any more money. You just gain more shares, but the value is exactly the same. But people do like stock splits, so you're able to gain more shares, and it makes it a little bit more attractive for newcomers, I guess you can say, because it is a lower price per share. But let's look at their earnings recently. Again, their earnings are coming out tomorrow, so this can make a buying opportunity if it drops even further, but it's still something interesting to look out for. So their revenue has actually been up over 11% year over year. So like I said before, kind of similar mindset to healthcare from before. They have that growth and also dividend, kind of same thing with TJX. They do have that growth behind them. Their revenue increased over 10%, and they have that dividend around 1.5%. So it does grow, but if it is during those downtimes, kind of like right now, you do get paid and keeping you happy. Real side note, if you're kind of interested in this type of play, like discount stores, like TJ Maxx, TJX, there are those other plays like Dollar General, Dollar Tree, and like the dollar stores. Those could be interesting as well if you want to get into that realm. Because during recessions, people tend to try and spend less, and those are the stores they go to. Now, before we go into third stock, guys, I do want to give a quick money tip of how we should start increasing our cash position. You know, stocks are great for the long term and everything. People say they're risky. Over the long term, honestly, if I'm talking like 10 plus years, it's not so risky because companies tend to grow over time. So if you're going to hold it and not touch it, you will make money. It's risky in the shorter term, like right now. So I would suggest start building up a cash position. Look at your time horizon. If you need this cash or the money in the near term, like within the next couple years, if you're looking for a car, house, or whatever, start building it up. Putting in a savings account, money market account, those are starting to pay a little bit of interest. There are T-bills out there. Quick note, I'm actually starting with T-bills. I'll have a video coming out talking about them very soon. They're kind of like CDs, just shorter. You can invest like a month, 2 month, 3 month, and you could get like over a 2% return. So you're investing in the government, safe, and it's more than a savings account. So that's another, it's like a cash equivalent. Warren Buffett does it. I'm starting to do play around with it, so I'll do that for you guys soon. Now I'm saying this because if you do need the cash in the near term and the market goes down like it has been, you're going to have less money, especially if you're looking for a large purchase like a house. You're going to have less money to put down, especially if the market continues to go down. You do want that liquidity and that cash on the side for opportunities so you could actually buy at cheaper levels. So don't have all your money in stocks right now. I wouldn't really recommend it. Have some cash for opportunity seeking, liquidity, and all that good stuff. Moving on to stock 3. Now this stock has been doing ridiculous. This is a growth stock, guys. Has no dividends whatsoever. I mean, I have been watching Jim Cramer, whether you like him or not. He's been liking this stock. I did some research into it. I'm loving it. I only heard about it like a few months ago. Let's just get into it. Is Five Below. I talked about them a couple times before. But they are very, very interesting. We could see their chart. Their PE is high because they are a growth company. So that's kind of expected. Their 1-year growth is over 90%. Their 2-year growth is over 180%, and their 5-year growth is over 100%. It was kind of like in the flat for a few years, but recently has been shooting off. Their 1-year target price estimate is around 132, so it is at a low point. Now I wanted to put this in because it does have that growth potential, but its earnings is coming out early December 5th. So this could either make it even more interesting, or it'll just pop and we might miss an opportunity. It really depends. But that's why I put it in stocks for December, because their earnings are coming out. So definitely keep an eye out for that. Let's go into some statistics. Trailing PE just over 50 and forward PE 36. It is on the high side, but that's because it's a growth company. As you can see from the 52-week change of over 100%. Yeah, that's right. You would have doubled your money. Now, one of the things that really interests me about this is that they are starting to expand their stores regionally throughout the country. And that usually helps the stock price very, very well. You could look at different companies that did that. AutoZone shot off, even Chipotle, even kind of Starbucks. But when they start expanding their stores all over the place, they start racking in. Stock price goes up like crazy. So I think this is going to be one of those stores. Now, real quick, what it is a retail store. It's not like a dollar store, but like in the name, Five Below, everything in there is $5 and less. It kind of relates to younger generation, like I don't know what you call them, teens, but in that area. But it does have a bunch of stuff in there, just for fun and whatever. So it is definitely like hip and everything like that. So I think a lot of people would enjoy it. So looking at their earnings, which was early September, their total sales were up 25% and operating income is up 41% year over year. And I was looking at their balance sheet, which is beautiful, by the way. Their debt levels, low. How low? I'm talking non-existent. So their balance sheet is actually beautiful. I really like this company. Has the growth potential behind them. That expansion of the stores I really like. Just the thing, it is volatile. It could be all over the place, especially with this crazy market. It has no dividends to keep you happy while it's down. But I would honestly rather get in around these levels. If earnings come out kind of bad and the stock drops a bit, that could be a great opportunity, because I'm thinking like years ahead when the stores are expanding nicely, you'll be up. And it is one of those stores that are kind of like going against Amazon. Like Amazon isn't eating into their profits. I mean, not yet anyway. Amazon's taken away from everyone. But definitely something to look into with growth. So let me know what you guys think. If you have any questions, comments, concerns, please leave them down below. I'd love to hear what you guys have to say. Just please be careful with growth and tech companies right now. Obviously things are really down. I mean, if you're looking like 5, 10 plus years, if you like the company and it's a solid company, don't worry about it. Hold on to it. Just understand this is a rough time and we have to diversify, which is why I got into these companies. Good diversification around different industries, have some dividends behind them to keep you happy. So if you have any recession-proof strategies, I'd like to hear what you guys have to say. So thank you so much for watching, guys. 3 stocks for December. Happy holidays. Hope just stay safe. But thank you so much for watching again, guys, and I'll see ya in the next one.